You ever look at a company's report and it feels like you're reading two completely different stories at the same time? Well, that's exactly what we're diving into today with Lux Industries. Their latest financial results, they're a real puzzle. On one side, you've got this incredible story of success and growth. And on the other, a story that looks a lot more like a looming crisis.
And here it is, the puzzle in its simplest form. Look at this. Lux Industries revenue. That's all the money coming in from sales. It shot up by a massive 22%. I mean, that's fantastic news, right? But then you look over here. Their net profit, the money they actually get to keep, it plummeted by nearly 60%. More sales, but way, way less money. It's a total paradox that just makes you scratch your head.
And ask, what is really going on here? How can a company be growing and shrinking at the exact same time? Well, to figure it out, we're going to tear down their financial reports. We're going to look at both the story they want to tell and the very different story the numbers are screaming. So let's start with the good news first. Okay, so this is the highlight reel. This is the story Lux wants everyone to focus on. A really powerful narrative about expansion, grabbing market share, and making bold strategic moves. It's the picture of a company that is absolutely firing on all cylinders. A 22% jump in revenue is seriously impressive. We're not talking about some small little bump here. This is a huge signal of strong demand. It tells you they're successfully taking a bigger piece of the pie. But, growth like this doesn't just happen by accident. So how'd they pull it off? Well, they did it with pure aggression. I mean, Lux went on an all-out blitz. They launched new products, signed a superstar brand ambassador in Huthik Russian, and massively expanded their dealer network. They made a huge push for online sales. They even built a gigantic new facility just to handle all the growth they were expecting. And get this, they backed it all up with some serious cash. Over 1,300 crore rupees. That's about 156 million US dollars plowed directly into branding and promotion in just the last 8 years. They are spending big to get big. This is a company in full-on attack mode. And just so you know where this optimistic story is coming from, it's all right here. The official filing they submitted to the stock exchange. It's all there in black and white. A story of powerful momentum and winning moves. But as we know, that's only half the story, isn't it? So let's flip the coin and look at the other side, the profitability problem. Because while all those sales numbers were soaring up, the actual profits, well, they were in a nosedive. This chart really tells you everything you need to know. Think of it this way. Last year, for every single rupee Lux made in sales, they kept about 9 paisa as operating profit. This year, that's dropped to just over 5 paisa. Their ability to turn a sale into actual real profit has been nearly cut in half. And hey, we're not the only ones who noticed this. One analyst called it the central challenge facing the company. That's a pretty big deal. It points to this fundamental disconnect between growing the business and making that business actually profitable. And there's that number again, the one that really stings. A nearly 60% drop in net profit. That's a massive, flashing red flag that something is seriously wrong with their business model. And one of the culprits behind this, the rising cost of money. Yeah, on top of everything else, their interest cost, that's the price of borrowing all that money to fund their expansion, surged by over 86%. It's like a vice, just squeezing their already shrinking profits tighter and tighter. So where does this all become crystal clear? Let's look at the numbers. Okay, time to play detective. Let's follow the money. We're going to dive right into their financial statements to see exactly where things went sideways. And you know what? The answer has been hiding in plain sight the whole time. It's right here in their official financial results. This one table tells the entire story, and we're about to break it down. And here is the whole story in one table. Look, revenue grew by a healthy 21.7%. Great. But, and this is the critical but, their total expenses grew even faster at 27.2%. And with their finance costs exploding by 86%, well, their profit had absolutely nowhere to go but down. It collapsed by nearly 60%. It's simple and it's brutal math. And look, this isn't just a one-off bad quarter. Analysts are seeing serious long-term red flags. Their return on capital has collapsed, which basically means they're getting way less profit for every rupee they invest. They're struggling to cover their interest payments. They're even taking longer to get paid by their own customers. And maybe the most telling sign of all, the big institutional investors, the smart money, they're selling off their shares. So after digging through all of that, what's the final verdict? What is the big lesson that every single one of us can take away from this whole tale of two reports? It all boils down to one critical concept: margin compression. It's when a company's costs are rising, but they can't or they won't raise their prices enough to cover them, probably because of fierce competition. This leads to a really dangerous situation called profitless growth. It's the illusion of success, where the sales numbers look absolutely fantastic, but the business itself is actually getting weaker. Now, putting Lux right next to its rivals really drives the point home. Its PE ratio seems kind of reasonable, but that's likely because the market is already factoring in these profit worries. And while its historical return on equity looks decent, we now know that number is dropping, and fast. The one bright spot here is their low debt, which does give them some breathing room, but it doesn't solve that core problem of shrinking profits. And that leaves us with this huge question, one that goes way beyond just Lux Industries. For any business out there, when does the pursuit of growth become too expensive? At what point does chasing more sales and spending big on expansion actually start to destroy value instead of creating it? It's a really fine line, and it's a critical one for any leader or any investor to think about.
Welcome back to the Deep Dive. Today we are shifting gears a little bit.
Yeah.
Usually we're wading through white papers, maybe stacks of articles, but today we are getting visceral. We are looking at a single image.
Just one screenshot.
That's it.
And honestly, it's a heck of a specimen to analyze.
It really is. So what we have here is a screenshot of a trading interface. I think it's the new Vama app, captured on a smartphone. And we are looking at the daily chart for Lux Industries. That's ticker LUXIND on the NSE.
Got it.
And I have to say, my immediate reaction to this visual, well, it's not pretty. If this chart were a person, it would be in the ICU.
It's definitely a chart that screams trauma. You look at that price action from, October through January, and it's effectively a crime scene.
A crime scene or a falling piano. I mean, we're seeing this massive, jagged decline, followed by what looks like a very recent, very shaky attempt to stand back up.
And that's the perfect setup for today. We aren't here to give financial advice. Right. Obviously, don't buy or sell based on us chatting about a screenshot. But the mission here is literacy. We want to decode the psychology on this screen.
Right.
Because when you strip away the ticker symbol, a chart like this is just, it's a map of human emotion. It's fear, it's capitulation, and then that tentative greed creeping back in.
Fear and greed, the oldest story in the book. So let's orient ourselves. We're looking at a daily candlestick chart. The x-axis, the timeline, runs from early October 2025 right up to today.
Right, February 17th, 2026. So we have about a 4.5-month window here. And the dominant feature is undeniably the trend.
Trend feels polite. This is a liquidation event. I mean, we start back in October, and the price is hovering around the 1,300 mark.
Yeah, I see the y-axis peak there at 1298.75.
Exactly. And it looks relatively stable there, maybe a bit choppy, but then come November, someone pulled the trap door.
It's a textbook waterfall decline. And
Please like
what
and
stands out to
subscribe.
me isn't just the magnitude of the drop. I mean, going from 1,300 down to a low of 755 is brutal.
It's huge.
But it's the character of the drop. Look at those candles in December and January.
Yeah, let's talk about that. For anyone who knows their way around a chart, we aren't seeing a lot of wicks on the bottom of those red candles. They look like solid blocks of red.
Exactly. We're seeing a lot of what look like bearish Maribozu candles or something close to it. That means the price opened, it traded down all day, and it closed right near the lows.
So no fight back during the day.
None. No buyers stepping in to buy the dip. Just sustained, relentless selling pressure day after day.
It's interesting you mentioned the lack of a fight back.
Yeah.
Because looking at that 1117.50 level, which, that looks like it should have been a support zone based on the chart structure.
It should have been.
It just sliced through that like butter.
And that's the definition of momentum. When you break a major structural level like 1100 without even a pause or a retest, it tells you the market sentiment has shifted from this is a correction to get me out at any price.
Oh, okay. And that brings us to the overlay. We've got these Bollinger Bands, the two wavy green lines, sandwiching the price action. I'm looking at the period from late December through mid-January, and the price isn't just inside the bands. It's practically surfing the bottom one.
That is a classic band walk. In a normal market, price tends to revert to the mean. That's that red moving average line in the center.
Right.
But here, the candles are just glued to the lower deviation band. Statistically, the price shouldn't stay at 2 standard deviations from the mean for that long.
So it's like stretching a rubber band until it's about to snap. But instead of snapping back, it just keeps on stretching.
Precisely. It indicates extreme weakness. The market is just efficiently repricing the asset lower day after day. But, and this is where it gets interesting, look at what happens in late January and early February.
The surf ride ends. The price finally detaches from that bottom green line.
And that detachment is your first signal. It doesn't mean buy, not yet, but it means the immediate crash level momentum is breaking. The rubber band can't stretch any further.
And now we're seeing a reversion toward the mean.
Exactly.
It's actually crossed the red center line now, too. So we've gone from hugging the floor to actually trading in the upper half of the channel. That's a significant shift in character, isn't it?
It is. It signals that the volatility regime is changing. We're moving from a trend of expansion on the downside to, well, a potential consolidation or even a reversal. The bands are starting to widen, and the price is exploring that upper range.
Okay, so the roadmap shows we've swerved out of the ditch. Now I want to look at the engine. Let's look at the RSI 14 panel right below the main chart.
The relative strength index. It's always the truth teller when it comes to momentum.
So I'm looking at the trough of the crash back in January. The white RSI line is just buried. It's deep below that dotted line. I'm guessing that's the 30 level.
Correct. When RSI dips below 30, we call that oversold. But you have to be careful with that term. Oversold can stay oversold for a long, long time in a strong downtrend.
Which we saw here.
As we saw here, yeah. It stayed down there for a while.
But look at the trajectory now. It's climbed out of the basement. The current reading on the right is 44.50.
44.50 is a fascinating number. It's no man's land.
How so? I mean, it's a lot better than 20. Right?
Oh, it is. It means the panic is over.
Yeah.
But in a bear market, which this stock is definitely still in, structurally, the 40 to 50 zone often acts as resistance for the RSI itself.
Really?
Yeah, bull markets see the RSI bounce between 40 and 80. Bear markets, on the other hand, see it oscillate between maybe 20 and 60.
So we are basically just testing the ceiling of the bear market range right now.
Exactly. Getting above 50 and holding it, that's the real litmus test.
Yeah.
Right now, at 44.50, we are just seeing a relief rally. The momentum is improving, but it has not proven it has the stamina to turn bullish yet.
So it's recovering, but it's not an athlete yet. It's just out of the hospital bed.
That's a great analogy. It's walking down the hallway, but don't ask it to run a marathon just yet.
All right, let's talk about the fuel.
Yeah.
The bottom panel. Volume. Because to me, this is the most dramatic part of the chart outside of the price drop itself.
And volume is the one thing you can't fake. Price can be manipulated, but volume. Volume is the receipt.
So during the slide November-December, the volume bars are relatively flat. They're low even. What does that tell you?
That's the vacuum. The price was dropping, not because everyone was selling at once, but because there were simply no buyers.
A lack of liquidity.
Yes. The price has to drop lower and lower and lower just to find someone who's willing to take the shares off the seller's hands.
But then, boom, look at early February. Around the 4th or 5th, that massive green spike, it just towers over everything else on the chart.
That right there,
Yep.
That is what we call stopping volume.
Stopping volume. Okay, unpack that for me.
Imagine a falling knife. Who catches it? You know, retail traders usually don't have the capital to stop a crash like this. When you see a volume spike that is 3 or 4 times the average daily volume occurring right at the bottom of a chart, that is institutional money.
So that's the smart money, finally stepping in and saying, okay, it's 750 rupees, this is cheap enough for us.
That's the theory, yeah. That volume spike represents a transfer of ownership. The weak hands, the people who held all the way down and finally couldn't take the pain anymore, they capitulated. And the strong hands, the institutions, the value investors, they absorbed all that supply.
It's a changing of the guard.
It is. And the fact that the price closed green on that high volume day confirms it was accumulation, not just more selling. It put a floor in the market.
But I do notice, looking at the far right, today's volume is tapering off a bit. It's not dead, but it's nowhere near that massive spike.
That's actually healthy. You don't want maximum effort every single day. You had the explosion of effort to stop the crash. Now you want to see if the price can float higher on just moderate volume. It means the sellers are drying up.
Okay, so we've got the context. The crash, the band walk, the capitulation volume. Now I want to zoom in on the specific day we are living in. The screenshot is from February 17, 2026, the current daily candle.
Let's look at the OHLC data at the top. This tells us the narrative of this specific trading session.
Okay, reading the tape. Open is 950.00. High is 984.90. Low is 950.00.
Okay, stop right there. Look at the open and the low.
They're identical, 950.00.
That is a massive signal of intent. The market opened and not a single share was sold below that opening price. Buyers were standing there at the bell, ready to go.
And that creates what we call a shaven bottom candle, right?
Right, a shaven bottom. It means immediate, urgent demand. And they pushed the price all the way up to 984.90.
Almost touching 985, but it didn't stay there. We closed at 970.3 euros, so we gave back about 15 points into the close.
Right. And that creates the upper wick or the shadow on today's candle.
Is that worrying, the fact that we couldn't hold the high?
It's reality. I mean, think about who is selling at 985. It's probably people who bought back in November on the way down who've been underwater for months. They see the price come back up and they think, thank God I can finally get out with a smaller loss.
The bag holders are looking for an exit.
Exactly. That overhead supply is what the stock has to chew through. So that wick isn't necessarily bearish, it's just the market absorbing those old sellers. The fact that we still closed at 970, significantly higher than the open, that's a win for the bulls today.
And visually, there's that dashed line across the screen marking the current price. It really highlights how far we've come from the bottom, but also how far we still are from the top.
We are climbing a mountain of regret. Every price level on the way up has people who bought there previously and might want to sell. That's why recoveries are jagged and messy, unlike the crash, which was just straight down.
Gravity works fast.
Gravity works fast. Climbing takes work.
So let's try to synthesize this. We have a listener looking at this deep dive in their mind. If we play devil's advocate here for a second, give me the bull case and the bear case from this chart.
Okay. The bull case is pretty compelling. You have a clear stopping volume spike, indicating smart money accumulation. You have RSI diverging from oversold conditions, and you have price reclaiming the midline of the Bollinger Bands. The crash phase is over. We're in an accumulation phase.
That sounds solid. But what's the bear case? Why should I be worried about buying here?
The bear case is one word: trend. The primary trend is still down. On the weekly time frame, we are making lower highs and lower lows. This bounce to 970 could just be a dead cat bounce or a relief rally before we roll over and test the lows again.
So, guilty until proven innocent.
Until RSI breaks 50 and the price starts making higher highs on this daily chart, yes. It is guilty until proven innocent. It's the only standard that keeps you solvent in a bear market.
I want to go back to that volume spike for a second. We talked about it being institutional, but isn't there a risk that it's just volatility? How do we really know it's accumulation, not just churn?
That's a great question. You look at the price reaction after the volume. If that huge volume spike happened and the price stayed flat or kept dropping, that would be bearish.
Right.
It would mean all that buying was just being absorbed by even more selling. But here, the price bounced aggressively after that volume. That confirms the buyers won that specific battle.
So the scorecard favors the buyers for now, at least in the short term.
In the short term, yes. The momentum has definitely shifted.
One thing we haven't touched on is the psychological toll of a chart like this.
Yeah.
If you were holding LUXIND from 1300 and you watched it go to 750 and now it's back at 970, what are you feeling?
You're bargaining. At 750, you were in despair. You probably deleted your trading app because you couldn't even bear to look. Now at 970, hope is returning. And that hope is actually dangerous.
Dangerous why?
Because if you're hoping for 1300 just to get your money back, you might ignore signs that the rally is stalling out at 1000 or 1050. You might turn a trade into an investment simply because you refuse to take a loss. This chart is a trap for emotional traders right now.
So for the new person looking at this chart, the person who doesn't own it, do they see a discount, a bargain?
And that's the classic question, isn't it? Is it a falling knife or a value play? If you are a technical trader, you see a setup with defined risk. You can buy here at 970, you put a stop loss below that recent low, and you have a clear invalidation point.
Right. If it breaks the low of that big green volume candle, the whole thesis is dead.
Exactly. The chart gives you the when and the where to manage your risk. Without the chart, you're just guessing that it feels cheap. And feeling cheap has bankrupted a lot of people.
I love that distinction. The chart provides the scaffolding for the decision. It doesn't predict the future, but it defines the battlefield.
It tells you the probability. And right now, looking at that RSI curling up and the Bollinger Bands opening up, the probability of a continued recovery is higher than it was 2 weeks ago. But it's not a guarantee. It's never a guarantee.
So before we wrap up, I want to leave the listener with a specific thought to mull over. We've looked at the pixels, the lines, the bars, but what's the meta message here?
I think the meta message is about reaction versus prediction. Too many people try to predict the bottom. It's at 800, surely it can't go lower, and then it goes to 750.
Right. Prediction is arrogance.
But this chart shows the value of reaction. We waited for the volume spike. We waited for the Bollinger Band detachment. We waited for the RSI to get back towards 40. We didn't catch the exact bottom, but we are looking at a much safer entry now than we were by guessing 3 weeks ago.
So the lesson is, you don't have to be the first one to the party. You just have to make sure the party is actually happening before you walk in the door.
Exactly. Let the institutions build the floor. You just stand on it once it's finished.
I think that's a perfect place to leave it. Whether you're looking at LUXIND or crypto or the S&P 500, look for the floor construction, not just the price tag. Thanks for dissecting this specimen with us.
Always a pleasure to decode the matrix.
Keep those charts open, and we'll catch you on the next deep dive.